The different forms of business organization: sole proprietorship, partnership, and corporation. Defining the pros and cons of sole proprietorship, the sole proprietorship structure has the benefit of simplicity and control, but the drawback of unlimited liability. Key points: the sole proprietorship is a type of business structure open to businesses run and owned by one entrepreneur. A large advantage of the sole proprietorship structure is its ease. The sole proprietorship structure does not require filing of articles of incorporation, regular meetings, or election of a board. A sole proprietor also files taxes as personal income. The other side of this process is the structure's main disadvantage. There is no separation between the entrepreneur and the business. This means the sole proprietor is personally liable for business losses. Also, if the proprietor dies, the business ceases to exist. Key terms: entrepreneur, a person who organizes and operates a business venture and assumes much of the associated risk. Proprietor, an owner. Business structures: business organizations can be structured in two major ways: in terms of their structures as legal entities, and in terms of the internal structure and management processes. The sole proprietorship is one type of business structure from a legal status perspective. It is a structure open to any business run and owned by one entrepreneur. Sole proprietorship. Pros and cons: a large advantage of the sole proprietorship structure is its ease of filing incorporation and tax documents, as well as having uninterrupted control of the business. The sole proprietorship is one type of business structure in the U.S. that does not require formal incorporation, meaning that a sole proprietor does not need to formally file articles of incorporation, hold regular meetings, or elect an advising or directing board. This simplicity is also reflected in tax treatment, as a sole proprietor files taxes as personal income. Sole proprietors also have control over the aspects of their businesses without the involvement of elected board members. Conversely, the sole proprietorship has one main disadvantage: there is no separation between the entrepreneur and the business. With sole proprietorships, like some forms of partnership, owners can be personally liable for business losses, meaning their personal assets are not protected against the claims of creditors. The sole proprietorship is not a separate entity from the owner/entrepreneur, unlike a corporation. As a result, if the proprietor dies, the business ceases to exist. Because the enterprise rests exclusively on one person, it often has difficulty raising long-term capital. Defining a partnership: the partnership is the simplest structure open to collaborative ownership. Its structure has the benefit of simplicity and control, but the drawback of personal liability for the partnership's activities. Key points: the partnership is a type of business structure open to businesses run and owned by two or more entrepreneurs. A large advantage of the partnership structure is its ease, in terms of filing and tax treatment. A general partnership can be started with no special formalities. The partners are taxed individually on their respective shares of the partnership's profits. The structure's main disadvantage is that partnership owners can be personally liable for business losses. The partnership is not a separate entity from the owners/entrepreneurs, unlike a corporation. Types of partnership beyond the general partnership have developed to mitigate some of the disadvantages of the structure. Limited partnerships and limited liability partnerships are two examples. Key terms: partnership, an association of two or more people to conduct a business. Liability, an obligation, debt, or responsibility owed to someone. Business organization types: business organizations can be structured in various ways, in terms of their structures as legal entities, and also in terms of the internal structure and management processes. The partnership is one type of business structure. The partnership is the next simplest business structure after the sole proprietorship. Because sole proprietorships can only have one owner, the partnership is the simplest structure open to collaborative ownership. Partnership. Pros and cons: a large advantage of the partnership structure is its ease in filing and tax treatment. With a general partnership, two or more people can start a business as co-owners with no special formalities, directly controlling the partnership and making binding decisions with a simple majority vote. The partners are taxed individually on their share of the partnership's profits. By default, profits are shared equally among the partners. However, a partnership agreement will almost invariably expressly provide for the manner in which profits and losses are to be shared. The structure's main disadvantage is similar to the sole proprietorship. Owners can be personally liable for business losses in some forms of partnership, meaning their personal assets are not protected against the claims of creditors. The partnership is not a separate entity from the owners/entrepreneurs, unlike a corporation. This means that the partnership structure is only as good as the partnership at the relational level. If the mutual consent to form a partnership breaks down, the partnership breaks down as well. Partnerships are considered to be an aggregate of their partners rather than a separate entity. There has been debate in most states as to whether a partnership should remain aggregate or be allowed to become a business entity with a separate continuing legal personality. Types of partnerships beyond the general partnership have developed to mitigate some of the disadvantages of the structure. Limited partnerships allow limited liability for some partners who have no management authority, and in some cases, depending on the jurisdiction, limited liability partnerships provide for limited liability for all partners. Limited liability company. What is an LLC? Limited liability company structure and benefits. Defined. What is a limited liability company, LLC? A limited liability company, LLC, is a business structure in the U.S. that protects its owners from personal responsibility for its debts or liabilities. Limited liability companies are hybrid entities that combine the characteristics of a corporation with those of a partnership or sole proprietorship. While the limited liability feature is similar to that of a corporation, the availability of flow-through taxation to the members of an LLC is a feature of a partnership rather than an LLC. Key takeaways. The limited liability company, LLC, is a corporate structure that protects its owners from being personally pursued for repayment of the company's debts or liabilities. Regulation of LLCs varies from state to state. Any entity or individual can be a member of an LLC, with the notable exceptions of banks and insurance companies. LLCs do not pay taxes on their profits directly. Their profits and losses are passed through to members, who report them on their individual tax returns. Understanding a limited liability company, LLC. Limited liability companies are permitted under state statutes, and the regulations governing them vary from state to state. LLC owners are generally called members. Many states don't restrict ownership, meaning anyone can be a member, including individuals, corporations, foreign entities, and even other LLCs. Some entities, though, cannot form LLCs, including banks and insurance companies. Internal Revenue Service. Limited liability company, LLC. An LLC is a formal business arrangement that requires articles of organization to be filed with the state. An LLC is easier to set up than a corporation and provides more flexibility and protection for its investors. LLCs may elect not to pay federal taxes directly. Instead, their profits and losses are reported on the personal tax returns of the owners. The LLC may choose a different classification, such as a corporation too, if fraud is detected or if a company fails to meet its legal and reporting requirements. Creditors may be able to go after the members 3 nolo. When you be personally liable for LLC or corporate debt. Important. The wages paid to members are deemed operating expenses and are deducted from the company's profits. Forming an LLC. Although the requirements for LLCs vary by state, there are generally some commonalities. The very first thing owners or members must do is to choose a name. Articles of organization can then be documented and filed with the state. These articles establish the rights, powers, duties, liabilities, and other obligations of each member of the LLC. Other information included in the documents includes the names and addresses of the LLC's members, the name of the LLC's registered agent, and the business statement of purpose. The articles of organization are filed, along with a fee paid directly to the state. Paperwork and additional fees must also be submitted at the federal level to obtain an employer identification number, EIN. Advantages and disadvantages of LLCs. The primary reason business owners opt to register their businesses as LLCs is to limit the personal liability of themselves and their partners or investors. Many view an LLC as a blend of a partnership, which is a straightforward business agreement between 2 or more owners, and a corporation, which has certain liability protections. Although LLCs have some attractive features, they also have several disadvantages. Depending on state law, an LLC may have to be dissolved upon the death or bankruptcy of a member. A corporation can exist in perpetuity. Type. An LLC may not be a suitable option if the founder's ultimate objective is to launch a publicly traded company. LLC versus partnership. The primary difference between a partnership and an LLC is that an LLC separates the business assets of the company from the personal assets of the owners, insulating the owners from the LLC's debts and liabilities. Both LLCs and partnerships are allowed to pass through their profits, along with the responsibility for paying the taxes on them, To their owners too, their losses can be used to offset other income, but only up to the amount invested. If the LLC is organized as a partnership, it must file Form 1065. If members have elected to be treated as a corporation, Form 1120 is filed. 5. In an LLC, a business continuation agreement can be used to ensure the smooth transfer of interests when one of the owners leaves or dies. Without such an agreement in place, the remaining partners must dissolve the LLC and create a new one. What is a limited liability company? A limited liability company, commonly referred to as an LLC, is a type of business structure commonly used in the United States. LLCs can be seen as a hybrid structure that combines features of both a corporation and a partnership. Like a corporation, LLCs provide their owners with limited liability in the event the business fails. But like a partnership, LLCs pass through their profits so that they are taxed as part of the owner's personal income too. What are limited liability companies, LLCs, used for? The LLC has two main advantages. It prevents its owners from being held personally responsible for the debts of the company. If the company goes bankrupt or is sued, the personal assets of its owner investors cannot be pursued. It allows all profits to be passed directly to those owners to be taxed as personal income too, that avoids double taxation of both the company and its individual owners. What are some examples of LLCs? LLCs are more common than many realize. Alphabet, the parent company of Google, is an LLC, as are PepsiCo Incorporated, ExxonMobil Corp., and Johnson & Johnson 6. There are many much smaller LLCs. There are variations that include sole proprietorship LLCs, family LLCs, and member-managed LLCs. Many physicians' groups are registered as LLCs. This helps protect the individual doctors from personal liability per medical malpractice awards. Are limited liability companies taxed differently than corporations? Yes. In the case of a corporation, profits are first taxed at the corporate level, and then taxed a second time once those profits are distributed to the individual shareholders. 7. This double taxation is decried by many businesses and investors. Limited liability companies, on the other hand, allow the profits to be passed directly to the investors, so that they are taxed only once. As part of the investor's personal income too, the bottom line limited liability companies, LLCs, are important legal structures for forming a business. Limited liability means that the assets and debts of the business remain separate from the personal assets and debts of the company's owners. If a company goes bankrupt, creditors cannot therefore go after the owner's personal assets, just that of the business. LLCs also have several beneficial features, including simplified taxation and a relatively straightforward process to establish one. This is part of the reason why LLCs are the most common type of business in the U.S., defining the pros and cons of a corporate structure. The corporate structure is less simple to found and maintain, but has the advantages of limited liability and perpetual life. Key points compared to sole proprietorships and partnerships. The corporation is more complicated to found and maintain. This is one of its disadvantages. The incorporator must file articles of incorporation, as well as hold an organizational meeting to elect a board of directors. The structure also generally requires the maintenance of at least annual reporting, including annual financial statements and other data. One of the most favorable advantages of the corporate structure is the protection of personal assets of stockholders, directors, and officers. They are limited in liability to the amount they have invested in the corporation. Also, because the corporation is an entity separate from its owners, ownership is easily transferable. Similarly, the corporation does not cease to exist with the death of shareholders, directors, or officers of the corporation. Key terms: liability, an obligation, debt, or responsibility owed to someone. Incorporate, to form into a legal company. Business structure: business organizations can be structured in various ways, in terms of their structures as legal entities, and also in terms of the internal structure and management processes. The corporation is one type of business structure. Corporation. Cons compared to other business structures, such as sole proprietorships and partnerships. The corporation is less simple to found and maintain. This is one of its disadvantages. The incorporator must file articles of incorporation with the Secretary of State's office in the state where it will be incorporated, as well as hold an organizational meeting to elect a board of directors. The structure also generally requires the maintenance of at least annual reporting. In many jurisdictions, corporations, whose shareholders benefit from limited liability, are required to publish annual financial statements and other data. This is so that any creditor who does business with the corporation is able to assess the creditworthiness of the corporation and cannot enforce claims against shareholders. Shareholders, therefore, experience some loss of privacy in return for limited liability. There is also the issue of double taxation, wherein the corporation is taxed on its profits and shareholders are also taxed on their earnings. Corporation. PROS. One of the most favorable advantages of the corporate structure is the protection of personal assets. Stockholders, directors, and officers of a corporation are typically not liable for the company's debts and obligations. They are limited in liability to the amount they have invested in the corporation. This limited liability also makes financing more attractive from a risk perspective. Also, because the corporation is an entity separate from its owners, ownership is easily transferable. Similarly, the corporation does not cease to exist with the death of shareholders, directors, or officers of the corporation. Another benefit of the corporate structure is that in the United States, corporations are generally taxed at a lower rate than are individuals. Best of both worlds. The S corporation is corporations or corporations that elect to pass corporate income, losses, deductions, and credit through to their shareholders for federal tax purposes. S status combines the legal environment of standard corporations with U.S. federal income taxation similar to that of partnerships. As with partnerships, the income, deductions, and tax credits of an S corporation flow through to shareholders annually, regardless of whether distributions are made. Thus, income is taxed at the shareholder level and not at the corporate level. Payments to S shareholders by the corporation are distributed tax-free to the extent that the distributed earnings were previously taxed. Also, certain corporate penalty taxes, EG, accumulated earnings tax, personal holding company tax, and the alternative minimum tax do not apply to an S corporation. Defining agency conflicts. Agency conflicts can occur when the incentives of the agent do not align with those of the principal. Key points. The agency view of the corporation posits that the decision rights control of the corporation are entrusted to the manager to act in shareholders' interests. Control systems in corporate governance can help align managers' incentives with those of shareholders and other stakeholders. The principal-agent problem concerns the difficulties in motivating one party, the agent, to act on behalf of another, the principal. The two parties have different interests and asymmetric information. Moral hazard and conflict of interest may thus arise. The deviation from the principal's interest by the agent is called agency costs. Agency costs mainly arise due to contracting costs and the divergence of control, separation of ownership and control, and the different objectives, rather than shareholder maximization, of the managers. Much recent interest in corporate governance is concerned with mitigation of the conflicts of interest between stakeholders. These occur when an individual or organization is involved in multiple interests that may lead to conflicts in their ability to act in the best interest of one party. Key terms: agent, one who acts for, or in the place of, another, the principal, by authority from him, one entrusted with the business of another, a substitute, a deputy, a factor. Principal, one who directs another, the agent, to act on one's behalf. Moral hazard, the prospect that a party insulated from risk may behave differently from the way it would behave if it were fully exposed to the risk. Principal-agent problem. The agency view of the corporation posits that the decision rights control of the corporation are entrusted to the manager to act in shareholders and other parties' interests. Partly as a result of this separation, corporate governance mechanisms include a system of controls intended to help align managers' incentives with those of shareholders and other stakeholders. The principal-agent problem, or agency dilemma, developed in economic theory, concerns the difficulties in motivating one party, the agent, to act on behalf of another, the principal. The two parties have different interests and asymmetric information, the agent having more information, such that the principal cannot directly ensure that the agents are always acting in the principal's, best interests. This is particularly true when activities that are useful to the principal are costly to the agent, and where elements of what the agent does are costly for the principal to observe. Moral hazard and conflict of interest, COI, may thus arise. The deviation from the principal's interest by the agent is called agency costs. Agency costs mainly arise due to contracting costs and the divergence of control, separation of ownership and control, and the different objectives, rather than shareholder maximization, of the managers. When a firm has debt, conflicts of interest can also arise between stockholders and bondholders, leading to agency costs on the firm. Examples of agency costs include the cost borne by shareholders, the principal, when corporate management, the agent, buys other companies to expand its power instead of maximizing the value of the corporation's worth, or by the constituents of a politician's district, the principal, when the politician, the agent, passes legislation helpful to large contributors to their campaign rather than helpful to voters. Much of the contemporary interest in corporate governance is concerned with mitigation of the conflicts of interest between stakeholders. A conflict of interest occurs when an individual or organization is involved in multiple interests that may lead to conflicts in their ability to act in the best interest of one party. In addition to conflicts of interest between managers, shareholders, and bondholders, conflicts of interest can also occur among other stakeholders of a company, such as the board of directors, employees, government, suppliers, and customers. QI is sometimes termed competition of interest rather than conflict, emphasizing a connotation of natural competition between valid interests rather than violent conflict. At other times, conflicts of interest are confused with cases that might better be termed corruption, such as bribe-taking or fraud. Defining managers, shareholders, and bondholders, three parties key to the corporation's functioning are managers, shareholders, and bondholders, each of which can have different interests. Key points: three parties key to the functioning of the corporation are the managers, shareholders, and bondholders. While managers control the corporation and make strategic decisions, shareholders are owners and bondholders are creditors. While all three parties have a direct or indirect interest in the financial performance of the corporation, each of the three parties has different rights and rewards. For example, voting rights or forms of financial return. Shareholders, managers, and bondholders have different objectives. For example, shareholders have an incentive to take riskier projects than bondholders do, and may prefer that the company pay more out in dividends. Managers may also be shareholders, or they may prefer risk-averse, empire-building projects. Key terms: bond, a documentary obligation to pay a sum or to perform a contract, a debenture. Dividend, a pro rata payment of money by a company to its shareholders, usually made periodically, quarterly or annually. Moral hazard, the prospect that a party insulated from risk may behave differently from the way it would behave if it were fully exposed to the risk. Managers control the corporation and make strategic decisions, while shareholders are owners and bondholders are creditors. While all three parties have a direct or indirect interest in the financial performance of the corporation, each of the three parties has different rights and rewards. For example, voting rights or forms of financial return. Shareholders, managers, and bondholders have different objectives. Stockholders have an incentive to take riskier projects than bondholders do, as bondholders are more interested in strategies that will increase the chances of getting their investment back. Shareholders also prefer that the company pay more out in dividends than bondholders would like. Managers may also be shareholders. They might reap the profits of riskier strategies, or they may prefer risk-averse, empire-building projects. Defining conflicts between managers and shareholders' agency costs mainly occur when ownership is separated, or when managers have objectives other than shareholder value maximization. Key points: the agency view of the corporation suggests that the decision rights of the corporation should be entrusted to a manager to act in shareholders' interests. Agency costs mainly occur when ownership is separated, or when managers have objectives other than shareholder value maximization. Typically, the CEO and other top executives are responsible for making decisions about high-level policy and strategy. Shareholders, on the other hand, are individuals or institutions that legally own shares of corporation stock. Shareholders typically concede control rights to managers. There are various conflicts of interest that can impact managers' decisions to act in shareholders' interests. Management may, for example, buy other companies to expand power. Venturing onto fraud, they may even manipulate financial figures to optimize bonuses and stock price-related options. Contemporary discussions of corporate governance argue that corporations should respect the rights of shareholders and help shareholders to exercise those rights. Disclosure and transparency are intimately intertwined with these goals. Key terms: shareholder, one who owns shares of stock. Agency costs. The term agency costs refers to instances when an agent's behavior has deviated from a principal's interest. In this case, the principal would be the shareholder. These types of costs mainly arise because of contracting costs, or because individual managers might only possess partial control of corporation behavior. They also arise when managers have personal objectives that are different from the goal of maximizing shareholder profit. Typically, the CEO and other top executives are responsible for making decisions about high-level policy and strategy. Shareholders, on the other hand, are individuals or institutions that legally own shares of stock in a corporation. Typically, these people have the right to sell those shares, to vote on directors nominated by various boards, and many other privileges. This being said, shareholders usually concede most of their control rights to managers. While attempting to benefit shareholders, managers often encounter conflicts of interest. For example, a manager might engage in self-dealing, entering into transactions that benefit themselves over shareholders. Managers might also purchase other companies to expand individual power, or spend money on wasteful pet projects, instead of working to maximize the value of corporation stock. Venturing onto fraud, they may even manipulate financial figures to optimize bonuses and stock price-related benefits. The chief goal of current corporate governance is to eliminate instances when shareholders have conflicts of interest with one another. Another important goal is to evaluate whether a corporate governance system hampers or improves the efficiency of an organization. Research of this type is particularly focused on how corporate governance impacts the welfare of shareholders. After the high-profile collapse of a number of large corporations in the past 2 decades, several of which involved accounting fraud, there has been a renewed public interest in how modern corporations practice governance, particularly regarding accounting. Advocates of governance typically encourage corporations to respect shareholder rights and to help shareholders learn how and where to exercise those rights. Disclosure and transparency are intertwined with these goals. Defining conflict between shareholders and bondholders, the shareholders and bondholders have different rights and returns, leading to potential conflicts of interest. Key points: the shareholders are individuals or institutions that legally own shares of stock in the corporation, while the bondholders are the firm's creditors. The two parties have different relationships to the company, accompanied by different rights and financial returns. Stockholders have an incentive to take riskier projects than bondholders do. Other conflicts of interest can stem from the fact that bonds often have a defined term or maturity, after which the bond is redeemed, whereas stocks may be outstanding indefinitely but can also be sold at any point. Bondholders may put contracts in place prohibiting management from taking on very risky projects or may raise the interest rate demanded, increasing the cost of capital for the company. Conversely, shareholder preferences, for example for riskier growth strategies, can adversely impact bondholders. Key terms: bond, a documentary obligation to pay a sum or to perform a contract, a debenture. Maturity, date when payment is due. Shareholder, one who owns shares of stock. Shareholders: the shareholders are individuals or institutions that legally own shares of stock in the corporation, while the bondholders are the firm's creditors. The two parties have different relationships to the company, accompanied by different rights and financial returns. For example, stockholders have an incentive to take riskier projects than bondholders do, as bondholders are more interested in strategies that will increase the chances of getting their investment back. Shareholders also prefer that the company pay more out in dividends than bondholders would like. Shareholders have voting rights at general meetings, while bondholders do not. If there is no profit, the shareholder does not receive a dividend, while interest is paid to debenture holders regardless of whether a profit has been made. Other conflicts of interest can stem from the fact that bonds often have a defined term or maturity, after which the bond is redeemed, whereas stocks may be outstanding indefinitely but can also be sold at any point. Bondholders, because bondholders know this, they may create ex-ante contracts prohibiting the management from taking on very risky projects that might arise, or they may raise the interest rate demanded, increasing the cost of capital for the company. For example, loan covenants can be put in place to control the risk profile of a loan, requiring the borrower to fulfill certain conditions or forbidding the borrower from undertaking certain actions as a condition of the loan. This can negatively impact the shareholders. Conversely, shareholder preferences, as for example riskier strategies for growth, can adversely impact bondholders. Goals of financial management. Strategic financial management. Definition, benefits, and example. What is strategic financial management? Strategic financial management means not only managing a company's finances, but managing them with the intention to succeed. That is, to attain the company's long-term goals and objectives, and maximize shareholder value over time. Key TAKDA strategic financial management is about creating profits for the business over the long run. It seeks to maximize return on investment for stakeholders. This differs from tactical management, which looks to seize near-term opportunities. A financial plan is strategic and focuses on long-term gain. Strategic financial planning varies by company, industry, and sector. Understanding strategic financial management. Strategic financial management is about creating profit for the business and ensuring an acceptable return on investment (ROI). Financial management is accomplished through business financial plans, setting up financial controls and financial decision-making. Before a company can manage itself strategically, it first needs to define its objectives precisely, identify and quantify its available and potential resources, and devise a specific plan to use its finances and other capital resources toward achieving its goals. Strategic management also involves understanding and properly controlling, allocating, and obtaining a company's assets and liabilities, including monitoring operational financing items like expenditures, revenues, accounts receivable and payable, cash flow, and profitability. Strategic financial management furthermore involves continuous evaluating, planning, and adjusting to keep the company focused and on track toward long-term goals. When a company is managing strategically, it deals with short-term issues on an ad hoc basis in ways that do not derail its long-term vision. Strategic financial management includes assessing and managing a company's capital structure, the mix of debt and equity finance employed, to ensure a company's long-term solvency. Strategic versus tactical financial management. The term strategic refers to financial management practices that are focused on long-term success, as opposed to tactical management decisions, which relate to short-term positioning. If a company is being strategic instead of tactical, it makes financial decisions based on what it thinks would achieve results ultimately, that is, in the future, which implies that to realize those results, a firm sometimes must tolerate losses in the present. Part of effective strategic financial management thus may involve sacrificing or readjusting short-term goals in order to attain the company's long-term objectives more efficiently. For example, if a company suffered a net loss for the previous year, then it may choose to reduce its asset base through closing facilities or reducing staff, thereby decreasing its operating expenses. Taking such steps may result in restructuring costs or other one-time items that negatively affect the company's finances further in the short term, but which position the company better to succeed in the long term. These short-term versus long-term trade-offs often need to be made with various stakeholders in mind. For instance, shareholders of public companies may discipline management for decisions that negatively affect a company's share price in the short term, even though the long-term health of the company becomes more solid by the same decisions. The elements of strategic financial management. A company will apply strategic financial management throughout its organizational operations, which involves designing elements that will maximize the firm's financial resources and use them efficiently. Here a firm needs to be creative, as there is no one-size-fits-all approach to strategic management, and each company will devise elements that reflect its own particular needs and goals. However, some of the more common elements of strategic financial management could include the following. Planning. Define objectives precisely. Identify and quantify available and potential resources. Write a specific business financial plan. Budgeting. Help the company function with financial efficiency and reduce waste. Identify areas that incur the most operating costs or exceed the budgeted cost. Ensure sufficient liquidity to cover operating expenses without tapping external resources. Uncover areas where a firm may invest earnings to achieve goals more effectively. Managing and assessing risk. Identify, analyze, and mitigate uncertainty in investment decisions. Evaluate the potential for financial exposure. Examine capital expenditures, CapEx, and workplace policies. Employ risk metrics such as degree of operating leverage calculations, standard deviation, and value at risk (VAR) strategies. Establishing ongoing procedures. Collect and analyze data. Make financial decisions that are consistent. Track and analyze variance, that is, differences between budgeted and actual results. Identify problems and take appropriate corrective actions. Strategies based on industry. Just as financial management strategies will vary from company to company, they also can differ according to industry and sector. Firms that operate in fast-growing industries, like information technology or technical services, would want to choose strategies that cite their goals for growth and specify movement in a positive direction. Their objectives, for example, might include launching a new product or increasing gross revenue within the next 12 months. On the other hand, companies in slow-growing industries, like sugar manufacturing or coal power production, could choose objectives that focus on protecting their assets and managing expenses, such as reducing administrative costs by a certain percentage. What are the benefits of strategic management? Having a long-term focus helps a company maintain its goals, even as short-term rough patches or opportunities come and go. As a result, strategic management helps keep a firm profitable and stable by sticking to its long-run plan. Strategic management not only sets company targets, but sets guidelines for achieving those objectives even as challenges appear along the way. What is the scope of strategic financial management? Strategic management can encompass all aspects of a firm's long-term objectives. Financial management often plays a key role in this, which involves cost reduction, risk management, and budgeting. What is the ultimate objective of strategic financial management? The goal of strategic financial management is to ensure that long-term goals are properly planned for and ultimately met. Defining valuation. Valuation is a goal of financial management. It often relies on fundamental analysis of financial statements. Key points in finance. Valuation is the process of estimating what something is worth. Valuation is used for a variety of purposes: the purchase or sale of a business, appraisal to resolve disputes, managerial decisions of how to allocate business resources, and many other business and legal purposes. Valuation often relies on fundamental financial statement analysis, using tools such as discounted cash flow or net present value. As such, an accurate valuation, especially of privately owned companies, largely depends on the reliability of the firm's historical financial information. Not only do managers want to keep reliable financial statements so that they can know the value of their own businesses, but they also want to manage finances well to enhance the value of their businesses to potential buyers, creditors, or investors. Key terms: valuation, the process of estimating the market value of a financial asset or liability. Fundamental analysis, an analysis of a business with the goal of financial projections in terms of income statement, financial statements and health, management and competitive advantages, and competitors in markets. Financial statement, a formal record of all relevant financial information of a business, person, or other entity, presented in a structured and standardized manner to allow easy understanding. Financial management. Financial management focuses on the practical significance of financial numbers. It asks, what do the figures mean? Sound financial management creates value and organizational agility through the allocation of scarce resources among competing business opportunities. It is an aid to the implementation and monitoring of business strategies and helps achieve business objectives. There are several goals of financial management, one of which is valuation. Valuation in finance. Valuation is the process of estimating what something is worth. Valuation often relies on fundamental analysis of financial statements of the project, business, or firm, using tools such as discounted cash flow or net present value. As such, an accurate valuation, especially of privately owned companies, largely depends on the reliability of the firm's historical financial information. Items that are usually valued are a financial asset or liability. Valuations can be done on assets, for example, investments in marketable securities such as stocks, options, business enterprises, or intangible assets such as patents and trademarks, or on liabilities, bonds issued by a company. Valuation is used to determine the price financial market participants are willing to pay or receive to buy or sell a business. In addition to estimating the selling price of a business, the same valuation tools are often used by business appraisers to resolve disputes related to estate and gift taxation, divorce litigation, allocate business purchase price among business assets, establishing a formula for estimating the value of partners' ownership interest for buy-sell agreements, and many other business and legal purposes. Therefore, not only do managers want to keep reliable financial statements so that they can know the value of their own businesses, but they also want to manage finances well to enhance the value of their businesses to potential buyers, creditors, or investors. Defining the goal of shareholder wealth. A goal of financial management can be to maximize shareholder wealth by paying dividends and causing the market value to increase. Key points. One interpretation of proper financial management is that the agents are oriented toward the benefit of the principals and shareholders. They aim to increase wealth by paying dividends and or causing the stock price or market value to increase. The idea of maximizing market value is related to the idea of maximizing shareholder value. Market value is the price at which an asset would trade in a competitive auction setting. For example, returning value to the shareholders if they decide to sell shares or if the firm decides to sell. There are many different models of corporate governance around the world. These differ according to the variety of capitalism in which they are embedded. The Anglo-American, US and UK model tends to emphasize the interests of shareholders. The sole concentration on shareholder value has been criticized for concern that a management decision can maximize shareholder value while lowering the welfare of other stakeholders. Additionally, short-term focus on shareholder value can be detrimental to long-term shareholder value. Key terms: market value, the total value of the company as traded in the market, calculated by multiplying the number of shares outstanding by the price per share. Principal: one who directs another, the agent, to act on one's behalf. Shareholder: one who owns shares of stock. Financial management is concerned with financial matters for the practical significance of the numbers, asking, what do the figures mean? There are several goals of financial management, one of which is maximizing shareholder and market value. Maximizing shareholder value. The idea of maximizing shareholder value comes from interpretations of the role of corporate governance. Corporate governance involves regulatory and market mechanisms, and the roles and relationships between a company's management, its board, its shareholders, other stakeholders, and the goals by which the corporation is governed. In large firms where there is a separation of ownership and management and no controlling shareholder, the principal-agent issue arises between upper management, the agent, and shareholders, the principals. There is potential danger that the board of directors may become insulated from shareholders and beholden to management, rather than overseeing management on behalf of shareholders. Thus, one interpretation of proper financial management is that the agents are oriented toward the benefit of the principals, shareholders, in increasing their wealth by paying dividends and or causing the stock price or market value to increase. Maximizing market value. The idea of maximizing market value is related to the idea of maximizing shareholder value, as market value is the price at which an asset would trade in a competitive auction setting. For example, returning value to the shareholders if they decide to sell shares or if the firm decides to sell. There are many different models of corporate governance around the world. These differ according to the variety of capitalism in which they are embedded. The Anglo-American, US and UK, model tends to emphasize the interests of shareholders. The sole concentration on shareholder value has been widely criticized, particularly after the late 2000s financial crisis, where attention has risen to the concern that a management decision can maximize shareholder value while lowering the welfare of other stakeholders. Additionally, short-term focus on shareholder value can be detrimental to long-term shareholder value. Defining the goal of financial management for stakeholders. Stakeholders are typically a diverse set of parties who can be affected by the business. A goal of financial management can be to maximize value without harming stakeholders. Key point stakeholders are those who are affected by an organization's activities. The stakeholders can be internal or external to the firm, and some will be involved directly in economic transactions with the business, while others will not. Owners, employees, customers, suppliers, trade unions, the government, local communities, and the environment can be considered stakeholders. Because of the potential breadth of the term, there are different views on whom to include in stakeholder considerations. Debate is ongoing about whether firms should be managed for shareholder value maximization or also with stakeholders in mind. While the Anglo-American model tends to emphasize shareholders, some European countries formally recognize other stakeholders in corporate governance decisions. Some proponents of stakeholder considerations argue that attention to other stakeholders is intimately intertwined with market value and can enhance outcomes for all stakeholders. Others argue that value should be maximized without harming stakeholders. Key terms: stakeholder, a person or organization with a legitimate interest in a given situation, action, or enterprise. Market value, the total value of the company as traded in the market, calculated by multiplying the number of shares outstanding by the price per share. Goals of financial management. Professionals in financial management are concerned with the practical significance of the numbers that appear in financial documents. Given a set of information about certain financial behavior, they ask, what do the figures mean? There are several goals of financial management, one of which is maximizing value without harming shareholders. The stakeholder concept. The stakeholder concept is associated with the concept of corporate governance. Corporate governance involves regulatory and market mechanisms and the relationships that exist between a company's management, its board, its shareholders, other stakeholders, and the goals for which the corporation is governed. Stakeholders are those who are affected by an organization's activities. The stakeholders can be internal, like owners or employees. They can also be external, like customers, suppliers, the government, local communities, and the environment. Some stakeholders are involved directly in economic transactions with the business. Others are either affected by or able to affect an organization's actions without directly engaging in an economic exchange with the business. For example, trade unions, communities, activist groups, etc. Because of the breadth of the term stakeholder, there are different views as to who should be included in stakeholder considerations. Stakeholders versus shareholders in the field of corporate governance and corporate responsibility. A major debate is currently occurring about whether a firm or company should make decisions chiefly to maximize value for shareholders, or if a company has obligations to other types of stakeholders. This increased after the financial crisis of the late 2000s, when concerns deepened about the potential of companies to lower the welfare of other stakeholders while maximizing their shareholder value. While the Anglo-American, US and UK, business model tends to emphasize the interests of shareholders over other implicated parties, some European countries formally recognize other stakeholders in corporate governance decisions. Some people who argue that businesses should consider other stakeholders, like the government or the environment, argue that an attention to these types of stakeholders is intimately entwined with market value. They'd also argue that a holistic view can enhance general outcomes for all the stakeholders that are involved. Still others argue that stakeholders, even if they are not considered in business decisions, should at the very least not suffer harm, and that businesses should maximize value only if they can do so without generating harm.